Good day and welcome to a training session offered by the Finance Department. Today's session is entitled Making Sense of Your Financial Statements. My name is Arnold Adey. I will be your presenter and moderator for today's session. I am an Assistant Finance Secretary within the Finance Department. My main areas of responsibility is management of the Department's 5 accounting centers, often called regional accounting centers. I coordinate the divisional and ministry unit budgeting and accounting processes. In addition to my work within the Finance Department, I have considerable volunteer experience within the Salvation Army. And prior to working for the Salvation Army, I worked for 13 years with Transport Canada in airport financial administration. Some housekeeping notes for today's session. We do have 58 participants registered for the session. As a result, communication is one way. If time permits at the end of the session, and we are scheduled for 1 hour, I think we will finish a little bit earlier, we may be able to respond to questions posted during the session. It is our plan to record this session and make it available for future viewing. If you become disconnected, you should be able to log in using the same process that you used to log in the first time. Unfortunately, we will not be able to troubleshoot access issues during the webinar. Are your reports confusing, or are they a useful tool for managing your ministry unit? Often readers complain of being bewildered. What use are reports to you? I hope this is not the case for you in your financial reports. Are your reports useful for analyzing your financial journey, or do they end up in the shredder? I hope that at the end of this session, your reports will not be in the shredder, but they will be in a prominent place where you can use them to help your ministry unit. We have 2 agenda items for today. We will start with a brief review of theory, and then we will follow up with review and interpretation of sample statements. Today's review will be fairly basic. I envision that we will follow up with a second advanced course at a later date. I'm going to start out by looking at a financial accounting flowchart. And it starts with the data collection, which is the collection of all of the daily, weekly transactions that would occur in your ministry unit. And then it moves into a data processing where you analyze, measure, and record various transactions. And it follows up with the generation of financial statements. From management's perspective, financial statements are important to help make decisions. That is their primary use. They are also useful to other stakeholders, divisional headquarters, congregations, government, other funders. Why are they important to you? If you are on a core council or if you are on a finance board, you have an obligation to know the financial position of the ministry unit, just as much as if you were the executive director or the treasurer or the bookkeeper. There are 2 primary purposes in accounting: to aid in management decisions and to assist the users of the statements or the stakeholders in evaluation. Perhaps a third purpose, although not listed, is to meet regulatory requirements and protect public interest. There are many users of accounting information. Management would use the information for self-evaluation. Congregations would use the information to hold the leadership accountable for the decisions that they would have made. Government is concerned about protecting public interest. The public and donors as well are concerned about the accountability and how the funds which they've provided to the Salvation Army are in fact used. What about program effectiveness? Can accounting information measure program effectiveness? They tend to focus on financial success more than program effectiveness. The financial statements do not usually measure the number of meals served, families helped, souls saved, but without financial success, meeting the program objectives are often short-lived. We are going to talk for a few moments about the accounting model. We will start with assets. Assets represent things that we own and it has value. We can look at some examples. Cash is an obvious asset. We own it and it has value. Accounts receivable, which represents monies that are owed to us, it has value, we own it, and it could technically be sold. Deposits held at THQ or DHQ, whether it's a capital deposit account, a property maintenance account, or a general deposit account, are all assets that have value. Land and buildings is an asset but not shown on ministry unit books. All land and buildings are owned by the Governing Council of the Salvation Army as the incorporated body for the Salvation Army in Canada and the Salvation Army Corporation of Bermuda in Bermuda. So land and buildings are held on THQ statements or the Corporation of Bermuda statements, but not on individual ministry units. Other assets held on ministry units books would include vehicles, furnishings and equipment, etc. But it doesn't matter whether assets are held on ministry unit books or territorial books, they are all included on consolidated statements. The second part of the accounting model is liabilities. Liabilities represent obligations. I often refer to liabilities as things we owe as opposed to assets, which are things we own. Accounts payable invoices is an example of a liability. We've purchased items on credit and now we have an obligation. Any salaries that are payable is a liability. Any payroll taxes that we've withheld from employees represent liabilities. What about the mortgage? The mortgage is not normally shown as a liability because we don't show the land or the building associated with the liability. So in most cases, mortgage payments are just recorded as an expense when we incur them. Some other examples of liabilities would be funds held on behalf of others, any rent that would be due if we rent space, those items would be considered liabilities. The third and perhaps the most misunderstood part of the accounting model is the fund balance. And the fund balance is the residual amount when all the assets are netted against the liabilities. It represents the amount owned by an organization for use at its own discretion. It does not represent cash. It is straightforward the difference between assets and liabilities. We will expand on this as we look at the statements in a few moments. There is a second part to the accounting model that we want to talk about as well, which is how the accounting model reports on operating activities. There are two types of transactions: revenues and expenses. Revenues represent an inflow of resources into the organization. Expenses represent an outflow of resources from the organization. Revenue and expenses do not always involve cash. Some examples of revenue: receipt of donations, rental of our buildings, government funding. Revenue is recognized with the inflow of an asset which may not be cash. For example, revenue from the rental of space is recognized when the building is rented, not when the rent is paid. At the time of rental, revenue is recorded along with the accounts receivable, which is an inflow of an asset. The cash may be collected later to be applied against the accounts receivable. This concept relates to double entry accounting, which we will not be dealing with, and you are probably happy to hear that, in this presentation. Some other examples are some examples of expenses, salaries, office supplies, management support assessments. Similar to revenue, expenses are recognized with the outflow of an asset or the creation of a liability. Now we're going to change focus and look at the second agenda item, review and interpretation of financial reports. I think I'll take a break and tell you a little story before we start about two accountants, and it's always bad when two accountants are in the same location, are in a bank when armed robbers burst in. While several of the robbers take money from the tellers, others line up the customers, including the accountants, against the wall and proceed to take their wallets and watches and whatever other money they might have. While this is going on, accountant number one jams something into accountant number two's hand. Without looking down, accountant number two whispers, "What is this?" To which accountant number one answers, "This is the $50 I owe you." So smart thinking on the part of the accountant to reduce their liabilities. There are four common financial reports. The first two are the most important and are the ones that we are going to look at today. The balance sheet and the statement of operations. The statement of operations is also called the income statement or the statement of profit and loss. We will look at the other reports in a different session. First, we will look at the balance sheet. A balance sheet reports the financial position of an organization at a particular point in time. The financial position is the amount of resources, example assets, and the liabilities or debts of the organization. The accounting model for the balance sheet, and there's an equation if you like math, is assets equals liabilities plus fund balance. This must always be true. If you ever see a balance sheet that the assets do not equal the liabilities plus the fund balance, then it's an invalid balance sheet. Sometimes the equation is switched around a little to say the fund balance equals the assets minus the liabilities. Some additional characteristics of the balance sheet. It lists all the assets, liabilities, and the fund balance at a specific point in time. It normally references as at, for example, June 30th, 2012. And it changes daily. The balance sheet of June 30th is different than the balance sheet of July 1st, which is probably different from the balance sheet of July 2nd. As mentioned earlier, the balance sheet must balance assets equals liabilities plus fund balance. It is accumulative in nature. It carries forward the results of operation in the fund balance since the inception of the ministry unit. It relies on the revenue and expenses to calculate the current portion of the fund balance, which is added to the fund balance of prior years, hence it being accumulative in nature. And we will elaborate on this quite a bit as we look at some statements. Let's look at a very simple balance sheet. First, there are assets. There could be more than what I've listed here, but to make it simple for illustration purposes, I've just listed two assets, cash and accounts receivable. Often the accounts receivable could represent funds due from residents or could represent a GST or HST receivables that charities are able to claim back from government. Secondly, we see liabilities. In this case, we just have accounts payable, representing items purchased on credit. And finally, we have the fund balance. Note that it represents an opening balance and a current balance. The opening balance represents the balance brought forward from the prior year, while the current balance represents the net of revenue and expenses for the current year. Some overall comments on this very simple balance sheet. There's no titles on this statement identifying the ministry unit. Normally there would be. And there's no date indicating the time of the statement. What can we conclude? We can conclude that there are sufficient assets to cover the liabilities with a $900 fund balance. We do have enough cash in the bank to pay our accounts payable. As I mentioned, the fund balance is $900, and in the current year, revenue is greater than expenses by $400. There's not a whole lot more we could interpret from this very simple balance sheet. We will look at some more detailed ones a little later. The other statement we will look at today is the statement of operations, or the income statement, as I generally call it. The statement of operation reports the revenue and expenses of an organization for a specific period. As discussed earlier, revenues cause inflow of resources into the organization, and expenses cause outflows. The accounting model for the statement of operations is quite simple. Revenue minus expenses equals net income, or sometimes net loss, or sometimes called net surplus or net deficit. Most organizations strive to have net income. In the corporate for-profit world, this is usually critically important. People invest money in corporations to make money. It is less important in the not-for-profit sector and in the Salvation Army, as program objectives are more important. For the Salvation Army, meeting basic needs within the community is more important than running a profit or creating net income. But a positive net income ensures that there are ongoing resources to fund program and to meet our mission objectives. Some key characteristics of the statement of operations. I'll run through these quickly. List all the revenue and expenses over a period of time, usually for a year or part of a current year. References for the year ended or period ended in its heading. Unlike the balance sheet, it is not cumulative over time. It reverts to zero at the end of each fiscal period, and we will talk about fiscal periods a little bit later, so just put that to one side for a moment. It reports a surplus or a deficit, or net income or loss. It is generally more valuable if it includes approved budget information, as management can evaluate results against preset objectives. For example, Is food and kitchen cost in a social center in line with budget? If not, why? Does corrective action need to be taken? The same could be said about cartridge donations at a core. Is it in line with budget? If yes, great. If not, why? If it's higher than expectations, even better. But being able to evaluate against some preset budget objectives can be very useful in evaluating your ministry unit. Now we're going to look at a very simple statement of operations or income statement. First, there is revenue. Given in this example we have cartridge income and donations, we can probably conclude that this is a core. There could be many other sources of revenue. Secondly, there is expenses. There could be other categories such as program costs, supervision costs, building costs, etc. And finally, there is a surplus or deficit. Some overall comments on this statement of operations. There's no titles on this statement identifying the unit. There is no time frame indicating the period, and there is no budget information. What else can you tell? Revenue is greater than expenses by $400. And this $400 ties to the balance sheet that we previously looked at, representing the current year portion of the fund balance. Note the net surplus is the same as this current balance on the balance sheet we looked at earlier. The net surplus or deficit always ties to the balance sheet. We are going to step back for a moment into a little bit of theory. We are going to look at the accounting cycle before we look at additional statements. The accounting cycle normally occurs over a 12-month period. It's referred to as the fiscal period. I made reference to that earlier. It may not be the same as a calendar year. For the Salvation Army, the fiscal period runs from April to March. The fiscal period is normally or usually divided into 12 months. Some businesses use different periods. Some report on a quarterly basis. Some businesses report on a 30-day cycle, and their periods are not monthly. This slide expands on the accounting cycle and year-end. Sometimes a difficult topic as well as to what happens at year-end in our financial statements. As mentioned earlier, assets equals liability plus fund balance. But perhaps we could restate that to say that at the beginning of the accounting cycle, assets equals liabilities plus opening fund balance. However, as time progresses within the year, we will accumulate revenue and expenses. So at the end of 1 month, assets equals liabilities plus the opening fund balance plus revenues minus expenses. You will notice we've broken down the fund balance into 3 parts here. The opening fund balance, the revenue minus the expenses, which is the current portion of the fund balance. At the end of 12 months, the equation has not changed. Assets equals liabilities plus opening fund balance plus revenue minus expenses. The only difference here is that the revenue minus expenses should be much greater during a 12-month accumulation than for the 1 month we looked at earlier. Then what happens? We start a new year. And at the start of the following year, assets equals liabilities plus opening fund balance. And the question is often asked, what happens to the revenue and expenses of the previous year? The revenue and expenses of the previous year always get added to the opening fund balance as we move into a new year. And we start all over again. So in that respect, this is where the balance sheet always keeps an accumulation of all the activities of the ministry unit since its inception, because every year the revenue and expenses get transferred to the opening fund balance. If they were equal, if revenue and expenses were equal, there would be nothing to transfer to the opening fund balance. To clarify what we just said, at the end of the accounting cycle, both revenues and expenses clear to zero, and the difference is added to the opening fund balance. And we can look at that numerically. Going back to the accounting equation, assets equals liabilities plus opening fund balance plus revenue minus expenses. Assets equals 10,000. Liabilities equal 5,000. That tells us, if the equation is correct, that the fund balance has to be 5,000. 2,000 opening fund balance plus 8,000 revenue minus 5,000 expenses equals the 5,000. At the start of a new year, the 8,000 and the 8,000 revenue and the 5,000 expenses, which are a total of $3,000, get added to the opening fund balance, and we start all over again. As I mentioned earlier, accounting is easy. Note that in any situation, the accounting equation always holds true in that assets equals liabilities plus fund balance, even if we break the fund balance down into opening portion plus the revenue and the expenses. Now we're going to look at some more sample statements, and we will look at the progression of a ministry unit from the first of the year to maybe the midpoint of the year, and then the end of the year, and just to see what happens and try to interpret a little bit what is represented in the financial statements. Let's look at the income statement for XYZ ministry unit. What does this statement tell us? It covers 1 month, April 1 to April 30th. It includes budget information. Often there would be a third column here to show the budget variance, the difference between the budget and the actual. What else do we see? Revenues is greater than expenses. $172,500 in revenue and $172,400 in expenses. A difference of $100. Is this what we planned? What did we plan? If you look at the budget column, we planned for a $375 surplus, net surplus. We ended up with a $100 surplus. That's pretty close when you look at activity for 1 month of in excess of $150,000. Income is higher than budget by about $11,500. What about expenses? They are also higher. Where? If you look, you can see that salaries and benefits are in fact higher than budget. so is program cost, and so is occupancy cost. Still difficult to tell a lot from this particular statement of operations in that we are pretty much on budget. Revenues are a little bit higher, expenses are a little bit higher. Often the two go hand in hand. If you have more revenue, you may have incurred more expenses to get that revenue. What does this tell us after 1 month? Not a lot. There could be some timing issues, but overall we can be fairly pleased with this statement of operations after 1 month. Now let's look at the balance sheet. First and foremost, the first thing I look at is there a positive fund balance? And there is. There's a positive fund balance of $2,100. Note the two parts to the fund balance. There's the opening fund balance of $200, and there's the current year portion of $100. And the current year portion of $100 ties to the statement of operations that we looked at a few moments ago. You can see them here and here. Can we afford to spend $10,000 for a new sound system? We have the cash. We have $32,000 in cash, but unfortunately we don't have the fund balance. The fund balance is only $2,100. It may depend, the question of whether we can buy a sound system, as to what we've planned for future income and expenses. But at this point, we do not have the resources to purchase a new sound system. You will note here that the accounts receivable is at $14,000. It's always important to watch accounts receivable as to whether it's increasing or decreasing. If it's increasing, that may indicate a concern in that we are not collecting from our accounts receivable. The other point here to note is that we have residence funds held in trust of $28,000. We need cash to meet those obligations to our residents. And that's probably why we are sitting with $32,000 in cash, because we need the cash to meet our obligations to residents. Let's move forward a few months to August 31st. And we are now going to look at another statement of operations for the same ministry unit. The only difference is the period covered now is April 1 to August 31st. What is different? Income, actual income, is now lower than expenses. What does this mean? It might mean they went and bought the sound system when they shouldn't have. It might be a seasonal variation in that income is down through the summer months. But if we look at income and compare budget to actuals, you will note that income is actually at $795,000 when we only budgeted $785,000. So we have a positive variance in income. So the problem appears to be with expenses. Salaries are higher than budget by $57,000. We had a budget of $400,000 and we've spent $457,000. Other costs, program costs, are below budget. Management support assessment is right on budget. And occupancy costs are a little below budget. But the net impact is that we have a net deficit of $7,400 when we had planned, according to the budget, to have a surplus of $10,000. That's a $17,000 swing in from what we expected to where we ended up. Now let's see what that does to the balance sheet as of August 31st. If we look at the balance sheet at first glance, the unit is bankrupt. Why do I say that? Because it has insufficient assets, $42,000, to meet its liabilities of $48,000. There's still lots of cash, $28,000, but we do have an obligation to residence funds of $33,000, and we have an obligation to creditors of $14,000, and we don't have sufficient assets to cover those. Why? Because we spent more for the first 5 months of the year than the amount of income we received. Many units become, hopefully not too often, technically bankrupt, but it's only an issue if everybody comes looking for their money today. If at August 31st, all the residents came looking for their money and the creditors came looking for their bill payment, this ministry unit could not meet its obligations. You can sometimes survive in the short term in this situation, but you cannot sustain it in the long run. Corrective action is required, either through additional income or reduced expenses. It would also be a good idea to collect as much of the accounts receivable that's on the books as well. Although if I remember correctly, accounts receivable at April 30th was around $14,000, so it's not increasing or really decreasing of any significance. Let's go forward a few months and see what happens when we move a little further along. Now we will move to March 31st. What does this income statement tell us? The situation has improved. The unit now has a surplus of $41,000. What contributed to the surplus? First and foremost, I noticed that donations are $40,000 over budget. We budgeted for $240,000. We actually received $280,000. Fee income and government grants are right on budget. What about expenses? Expenses remain close to budget. Some are over while others are under. We've spent a little more in salaries and benefits, but our program costs and our occupancy costs are down slightly. So we had planned for a surplus at the end of the year of $4,500. We ended up with a $41,000 surplus, which is much improved from where we were. Now what does our balance sheet look like? Remember, net surplus $41,021. If we go to the balance sheet, the fund balance has improved. You'll notice now we have a $43,000 fund balance, which is made up of the $41,000 net surplus in the current year, plus the $2,000 opening fund balance that was brought forward from the other years. Note that there's a much larger fund balance there now. It's $43,000, as opposed to when they started the year, they only had a $2,000 fund balance, which didn't give them much cushion or much of a safety net going forward. there is an IHQ requirement that the unrestricted fund balance, and we'll talk about this in a moment, should be equal to 3 months of your average expenditures. So if you had expenditures of $1 million, you should have approximately, let's say it was 1.2 million, you should have $300,000 in a fund balance. This unit still doesn't have close to a 3-month operating reserve. Note as well on this balance sheet that there are now some funds held at THQ in a deposit account. The funds that are held at THQ are still assets, and they are still owned by the ministry unit. So in this particular example, during the course of the year, the ministry unit temporarily went into bankruptcy in August, but ended the year in a much better position at the end of the year. What happens if we move forward one day? What is different with this balance sheet? If we now move into April 1st, 2012, we haven't yet incurred any expenses or received any income. There's only one change on this balance sheet. And it's with the current surplus, the 41,000 current surplus has now transferred up to the opening fund balance. Everything else on the balance sheet remains the same. We're going to look at some other statements for probably about another 10 minutes, and then I suspect we will clue up. They'll get a little bit more detailed, and I will try to simplify it as much as I can. This is a fairly simple balance sheet, but there's a couple of interesting things on here that I wanted to highlight. It doesn't identify the ministry, you will note. What's different here is that if you look at the asset side, it has cash, it has a PMA deposit, it has accounts receivable, which is quite high in relation to the total assets, and as well it has a vehicle. You'll notice two parts to the vehicle. It says vehicle $40,000 and then accumulated depreciation of $17,000 in brackets. The $40,000 would represent the purchase price of the vehicle, and what happens with what is referred to as fixed assets, or like that you purchase that has value, the expense of that vehicle is spread over a number of years through an expense called depreciation. So the vehicle was purchased at $40,000 and it has now been depreciated by $17,000. So the net book value on the books of this vehicle is now sitting at $22,560. And that should highlight there in a moment. The other thing I wanted to highlight on this particular balance sheet was the fund balance section. You'll notice here that I've got a number of different fund balance categories. And there's generally 4 that we use within the Salvation Army. There's an operating fund balance, or sometimes called unrestricted fund balance, which means there are no restrictions on that particular fund balance. There is an internally restricted fund balance. Sometimes management of a ministry unit may look at the accumulated fund balance and say that we want to use a part of that for a particular purpose. They place what we would call an internal restriction on that fund balance. The third one here is called externally restricted fund balance. That's normally when we've been given income from an outside source to be used for a particular purpose. And generally that would go into an externally restricted fund balance. And the final fund balance, and this doesn't say fund balance, but it's the invested in capital, that represents the net book value of the assets, or the vehicle, sorry. When looking at the fund balance, it has a fund balance of $65,000, but part of that is invested in a vehicle. You can't easily use the vehicle for any other purpose unless you were to first sell it and then realize cash. You can't use an externally restricted fund balance for purposes other than which the donor initially intended it. You can, if management is in agreement, change internally restricted fund balances and move them back to the operating fund balance or make them unrestricted. While not shown here, each of those fund balances, the operating, the internal, external, and invested in capital, would all have an opening balance and a current year balance, the same as we looked at in the earlier example. Normally, there would be separate statement of operations or departments that would close its revenue and expense accounts to different fund balances. And the final statement we are going to look at is going to go and show us that. Okay, we're looking at one final set of statements, and they keep getting a little bit more complicated each time. In this case, we've only shown the asset and the liability portion on the first page that I'm presenting. You'll notice I've added in account numbers which come out of the accounting system. And I've highlighted in yellow sort of the categories. Total assets, $105,000. Total liabilities, $500. In this particular example, the ministry unit has lots of assets, very few liabilities. It has cash of $37,000, a PMA deposit of $9,000. It has accounts receivable of $18,000, and then probably about 40% of its assets are invested in vehicles with a net book value of $40,000. But it has lots of cash to meet its current liabilities. When we go and look at the fund balance, we can immediately tell what the fund balance is going to be, because if we take assets equals liabilities plus fund balance, the assets are $105,000. We only have liabilities of $500. The fund balance should be somewhere around $105,000. I've gone to the second page of this financial statement, which shows the fund balance. If you look down at the very bottom, highlighted in yellow, it says total fund balance, $105,000. Surely we can spend $30,000 for new seats for the sanctuary. What do you think? We've got lots of fund balance. Let's look a little bit further. You'll notice I've highlighted in yellow the various groupings of fund balance. I've got operating fund balance, $44,000, the first yellow highlight. I've got total internally restricted fund balance, $9,000. And I've got total externally restricted fund balance, $11,000. And then we've got invested in capital, $40,000. Well, the invested in capital can't be used to purchase new seats for the sanctuary, nor can the externally restricted fund balance or the internally restricted fund balance. But we do have an operating fund balance of $44,000. Unfortunately, if we look a little bit closer, the fund balance, the operating fund balance, is broken down between the senior corps, the youth program, the senior band, songsters, and family services. And you'll see each of them there on the slide. Unfortunately, when we look at the senior corps, it actually has a negative fund balance. It has minus $23,8106 as its fund balance. So in essence, the senior corps is bankrupt. There are are other sections of the Corps that have money, but the Senior Corps does not have funds to purchase new pews for the sanctuary. Let's briefly look at the other funds. Youth has $15,000 fund balance. Senior Band has $15,000, and they're made up of an opening and a closing, an opening and current year portion. Songsters has $10,000. Family Services has $26,000. We have internally restricted funds of $9,000, which we've designated $9,655, which we've designated for PMA. As well, we have $11,000 in externally restricted funds, which were collected for Partners in Mission and our sponsorship program. And finally, we have the invested in capital of $40,000, which is the undepreciated portion of the vehicle. How do we keep track of the separate funds? I mentioned we usually do that with separate departments, with separate revenue and expense accounts that close to separate fund balance accounts. We can see this in the following statement of operations, and we're going to look at some of the individual, what I will call departmentalized statement of operations. Let's look briefly at the Senior Corps. How are we doing for time? We've got about 10 minutes left. We'll have plenty of time. Let's look at the Senior Corps. This statement represents 1 month's activity. It says at the top, April 30th, 2012. Usually there would be many other accounts in here, but I've simplified it just to put it on one slide. As an example, there would be many personnel expense accounts, salaries, CPP, EI, RRSP expense, if they're officer vehicle expenses, quarters expenses, but I've summarized them for illustration purposes. You will note here that there is a $1,000 interdepartmental transfer at the very top. That's a little bit different than income and expenses, and I didn't mention these before. Interdepartmental transfers represent grants between departments, and they net to zero across all departments. They are used to avoid double counting. For example, and I can probably use, if a thrift store received income of $5,000 and then decided to transfer it to the Family Services, and they recorded an expense and the Family Services recorded income, we would double count the income. So what we've done is use this concept called interdepartmental transfers, where there's a minus amount in the department that transfers the funds and a positive amount in the department receiving the funds. When you add them all up for consolidation purposes, it always nets to zero. We'll see the other side of that in a moment. So when we look at the Senior Corps in the current year, it has $18,000 expenses, or income, I'm sorry, $13,000 worth of expenses, for a net surplus of $5,900 after transfers. It has a positive net surplus for the first month compared to a budget of $50,000. Which is pretty good. But let's go back to the balance sheet just to see the impact on the balance sheet. You'll notice that they had a net surplus of $5,917. When we go back to the balance sheet that we looked at a few moments ago, the net surplus on the statement of operations for the Senior Corps transferred to the Senior Corps fund balance for the current year. So it reduced its deficit in the first month of the year from $28,000 to $23,000. Here is the Youth Department, and I won't belabor these. The Youth Department had income of $145, expenses of $140 for a $5 surplus for the month. The Senior Band had $105 in income, $484 in expenses for a $379 loss. They didn't budget for a loss, but the actuals are different. Let's look at those in the balance sheet. You'll notice you'll see youth program where the $5 net surplus transferred in, and for the senior band where the $379 net deficit transferred in. In all of the other fund balances, there would be a statement of operations that would have amounts that would transfer into the fund balance as well. Here is the songsters. I want to look at the songsters because this is where the other side of the interdepartmental transfer had occurred. The songsters in the month of April had transferred $1,000 to the senior core. I don't know why. It was something that was probably done as part of the budget because it's indicated in the budget. And the songsters had planned to break even for the month of April, but you will note that they ended up for April month with a negative $403 after the interdepartmental transfer. Remember, the interdepartmental transfers net to zero on consolidation. Similar for family services. There was no PMA activity in the current year. And I just mentioned there is a department for restricted donations that has its own department. I think it's 920 in the Shelby accounts. And you'll notice here that all we've recorded is income in Partners in Mission of $215. We haven't recorded any sponsorship income as of yet. And that $215 net surplus would transfer to the fund balance. We have capital assets. All that normally gets recorded into capital assets is the depreciation on the vehicle. Or if there was any new purchases, there might be some transfers in representing income or interdepartmental transfers to reflect the purchase of a new asset. As we have shown, there can be many different departments that can close to different parts of the fund balance. Normally, a single department closes to a single fund balance, although there are some cases where a department can be set up to have various income and expense accounts that close to unique fund balance accounts even within a department, but that's not that common. But it doesn't matter how many departments you have, they all must close to a fund balance, and in all cases the assets must equal the liabilities plus the fund balance, or assets equals liabilities plus the opening fund balance plus revenue minus expenses. You need to analyze all three sections to determine the health of the ministry unit. You have to look at their assets, liabilities, and the fund balance in conjunction with the statement of operations to really get a sense of how the ministry unit is doing. And you have to look at it in conjunction with the budgeted activity as well. That concludes our session for today. We went a little longer than I thought we would. I don't think at this point we will have time for questions. I would thank each one of you for your attendance. As I mentioned earlier, this session will be recorded. We will make the details available as to how you can access the recording at a later date, although I'm not so sure why anyone would want to listen through this recording again. This is the first training session we have delivered in this manner within the finance department. It has been somewhat of a test. We were certainly pleased to see the number of people that registered and were able to attend, so thank you. I will be in the next few days sending out a short evaluation for you to complete to help get us feedback on the course effectiveness. Whether you could hear me, which I assume you can, whether the material was too much, too complex, whether the session should be shorter. We will give you an opportunity to provide some feedback so that we can modify future courses as appropriate. Once again, thank you again and have a great day.